What's up, guys? In today's video, we're going to talk about what's wrong with Dave Ramsey's investment strategy, so stay tuned. All right, guys, so like I said, in this video, we're going to talk about where I disagree with Dave Ramsey. As many of you know, if you've been watching my channel for a while, you know that I highly recommend a lot of Dave Ramsey's stuff. I think there's a lot to be said for, his book, Financial Peace, for Financial Peace University. Even though I recommend his book and a lot of his methods, I don't agree with him completely. There's a lot of things that I strongly disagree with, actually. Before I go on, I should say that there's a lot to be said for staying out of debt. There's a lot to be said for buying with cash. There's a lot to be said for looking for extremely good bargains. And there's a lot to be said for understanding the gravity, the weight, the psychological stress that negative cash flow has, not only on your wallet, but on your mindset as an investor or as a business owner. So even though I disagree with a lot, I also agree with a lot, and I think that's definitely worth mentioning. Far and away, my biggest disagreement with Dave Ramsey is his investment strategy. This idea that you're supposed to put most of your money in 401ks and high yield mutual funds is, I think, completely wrong. First of all, Dave recommends that you invest in mutual funds that give you an annual yearly return of 12%. Well, most mutual funds don't do that, but there are some that have shown over the course of time that they have produced that yearly average of 12%. I think Vanguard's supposed to be a pretty good one. There are a couple other good ones that he recommends, but just because they have a history of doing that does not mean that they're going to continue doing that in the future. It's much riskier than real estate. Now, everything has risks. There are risks in real estate, but that's why you buy for a very, very low price, so that you know that if you ever get into hot water, or you ever need to sell for any reason, you should at least be able to get your money back. I mean, I bought this house right here for $5,500. I'll probably have about 17 to 18.5 in it by the time I'm finished. And there's no way that if I wanted to sell it tomorrow that I couldn't at least get $18,500 for it. Now, that's not what I'm going to do. I'm going to keep it for cash flow, but that's neither here nor there. My point is, if I'm going to put most of my money into something, then it's going to be into something that is very low risk and has the potential for a really high return. So that's number one. The second thing is 12% is just way too low. It seems really glamorous the way that it's described in the book and the way that a lot of people describe it. You put a certain amount away every single month in this high yield mutual fund that gets you 12%, and in 40 years you have $2 million or $2.5 million, and then you're a 65-year-old, multi-millionaire, and that sounds great, right? But what all of these books ignore is the fact that in 40 years, $2 million is not going to be worth what $2 million is worth right now. So this right here is a website. It's called thepeoplehistory.com, and it has all kinds of information about, what things cost back in time and what they cost now. They haven't gotten all of the 2018 numbers yet, so I'm going to go with 2017's numbers, and we're also going to look at what things cost 40 years before that in 1977. So if you look right here, you can see that the average cost of a new house in 1977 was $49,300, right? And if we go forward in time to 2017, you can see that the average cost of a house, a new house, this isn't just a house in general, it's new construction for both of them, then the average cost is $371,200. So that's roughly 7.5 times as much as it cost to buy a new house in 1977, 40 years ago, okay? Let's look at rent. The average cost of rent in 1977 was $240 a month. If you fast forward to 2017, the average cost of rent was $1,600 a month. That's almost 7 times as much as it cost in 1977. So when you look at this idea that, okay, I'm going to put this much away in these mutual funds that are going to hopefully earn me 12%. If all goes well, in 40 years, I'll have $2 million. go ahead and divide that by 7, and that's what you've really got. That's roughly $286,000. So you think that in 40 years you're going to have $2 million, but really you're going to have about $286,000, at which point you can either take it all out and hope that you die before that $286,000 runs out, or you can live off the interest and make roughly 12% of $286,000. We'll just call it $30,000 a year for the rest of your life. That's why I really disagree with Dave Ramsey's investing method. Instead, I would prefer to put a lot more effort into investing at a younger age. So I'm putting most of my energy towards investing. It's a more active type of investing as opposed to a passive type of investing. But because of that, I'm going to be a lot better off if I make it to 65. If not, I'll still be better off up to that point. So that's why I focus on buying these houses that I can get these incredible returns from, these 40% or greater yearly return on my investment. And I'm not going to go into all the math now. I'll put some links in the description below where I go into great detail on how you can build up to where you're making $400,000 a year in passive income, and anywhere from 5 to 10 years. It really just depends on how much money you put into it. But even for a blue collar individual that only makes $40,000 to $50,000 in 10 years, they can absolutely be making $400,000 a year. And I show you how to do that in these other videos, so I'll post them in the link. But here's the real beauty of that plan. If you do put most of your energy, most of your effort, most of your money into these types of properties that earn you that crazy high return, that 40% yearly return, then that money to a good extent is inflation proof. As a matter of fact, your income goes up as the cost of living goes up. So if you in 10 years have a portfolio that is producing $400,000 a year in cash flow, then 40 years from now, if history repeats itself, it's going to be bringing in roughly $2.4 million a year. So instead of, suffering and scrimping and saving and, building up this lump sum of $2 million after 40 years, you're bringing in $2.4 million every single year. And that is if you stop investing after 10 years and you just let it sit and you maintain that property. So the main takeaway from all this is that I think it's very important that you don't focus on these mediocre results. In the stock market, as far as mutual funds go, 12% is actually extraordinary. But in general, as an investment, I don't consider a 12% yearly return extraordinary. I consider it mediocre because I see how you can do so much better. So focus on those things. Focus on what can get you the highest yearly return and how can you duplicate it over and over and over again and flip that snowball on its head so it becomes an investment snowball instead of a debt snowball. And if you don't think it's possible, if you feel like you're stuck, if you're a blue collar guy, or a girl, you're making $30,000, $40,000, $50,000 a year and you don't see how it's possible to come out of that, then feel free to shoot me a message on Facebook or join the Rental Property Investors group on Facebook. Either way, I'd love to talk with you. I'd be happy to tell you what I know, and I'd love to help you get out of that mess. I don't charge for it. I just like to help people. So if you need help, if you don't see a way out, then absolutely reach out to me. That's what I created this channel for. It was to help people. So that's all I've got for you in this video. If you haven't already, please like and subscribe, and I will see you guys in the next one.